The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You need to make the call, 800-306-1990, 800-306-1990, and every day at this time, OBMMI. They provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. Let's take a look and see what rates did yesterday. Now, this is the raw rates. They don't tell us points paid, points received, or the APR. This is the number you put in the mortgage calculator. You get the mortgage calculator free on our mobile app, ronismylender.com, ronismylender.com. 30-year conventional rates up yesterday, 6.107. 30-year jumbo rates up yesterday, 6.49. FHA 30-year fixed up 5.9. VA 30-year fixed up 5.52. USDA 30-year fixed up 6.02. Clean sweep. Every one of them went up yesterday. If you want our thoughts about the market, rsrlinks.com/market minute, rsrlinks.com/market minute. Every morning, as early as the data allows, we put out a report to our subscribers, and it's free, so you don't have to pay anything. It's a free subscription. rsrlinks.com/market minute. We put that out as early as the data allows. What's happening in the markets today? Well, we've got the S&P 500 is up 12.28. The 10-year Treasury flat. Mortgage-backed securities are up ever so slightly, 4 basis points. And remember, when the bond goes up, rates go down. Now, there is a correlation between the 30-year fixed rate loan and the 10-year Treasury. I'm not going to get into that in too much depth today, but there is a correlation in those. What else is there a correlation in? Well, so it's a global economy. We talk about that all the time. Why are we seeing some of the 10-year Treasury bond, the bonds go up, the mortgage-backed security bond go up? Why is that? It's a global economy. Bonds do not like inflation. And the People's Republic of China announced several measures of stimulus to try to help spur economic activity and help their financial markets. It includes cutting the reserve requirement ratio, freeing up an estimated 1 trillion yuan in lending, cut the 7-day reverse repo rate, slashed average interest rates paid on existing mortgages by 0.5%, lowered minimum down payment to buy a home to 15%, created a 500 billion yuan swap facility to lend money to funds, insurers, and brokerage firms to use buy stocks, created a 300 billion yuan relending facility given to commercial banks that would in turn lend the money to companies and other entities for stock buybacks. People's Republic of China is essentially putting a floor beneath their housing and stock markets, and if successful, could create more economic activity in the global markets. As a result, Chinese stocks are moving higher, as well as commodity prices. Bond markets around the globe are moving lower in price and higher in yield as it's being viewed as inflationary. If you remember, our Federal Reserve was increasing our interest rates on their Fed funds rate as the inflation was so high. This is just the opposite. They're reducing their rates to get more money into the economy in China, and the belief is it could cause inflation around the world. Let's see what else the Federal Reserve is talking about today. The Atlanta Fed president, Raphael Bostic, said he was in favor of cutting 50 basis points because this is what last week's market, because the uncertain trajectory of the labor market. He also explained that the Fed can now slow down the size of cuts to 25 basis points unless the labor market shows further signs of material weakening. As mentioned on Fed Day, all 19 Fed members do not see the unemployment rate rising past 4.5% this year. If the unemployment rate gets to 4.5 or above, the Fed may have to cut more aggressively. Chicago Fed President Austin Goolsbee happy with where inflation and the labor market is today, but if they want to keep things that way, the Fed cannot wait for problems to show up and cannot be behind the curve if they want to avoid recession. Goolsbee said, quote, "When inflation is coming in at the target and unemployment is where you want it, do you want to be the tightest in decades? If you're too restrictive for too long, you're not going to be at the sweet spot on the dual mandate for much longer," unquote. Goolsbee explained that Fed funds rate is hundreds of basis points above neutral and that the Fed funds rate has a long way to come down to get to neutral, where the Fed is neither restrictive or stimulative to the economy. Almost all the Fed members are citing great progress on inflation and worries about the labor market. Does that surprise anybody? Except for Fed Governor Bowman, who has the lone dissenter at the September 18th Fed meeting. Bowman said today that inflation remains uncomfortably above their 2% target and that progress on inflation could stall. She said that low inventory and home prices are to blame, but they are not even included in the appreciation reports. Additionally, she thinks there are risks to inflation because of the labor market, which she sees as being near full employment. She also cited that unemployment rate fell in the latest report from 4.3 to 4.2. But if you listen to Ron Siegel Radio on a regular basis, you know that that was just a rounding. It went from 4.25, which is rounded to 4.3, to 4.22, rounded to 4.2. That's only a 0.03% change. Poorly informed, in my opinion. I've shared that with you before. Of course, you know my opinion of most of the Fed members.
Such an idiot.
Yeah,
Such an idiot.
So inflation has made significant progress. It's not far from the Fed's target. It's being held up by lagging shelter and motor vehicle insurance, which the Fed can't control motor vehicle insurance. Additionally, while the unemployment rate is historically low at 4.2%, it's about the relative change, which is up 0.8% from the cycle low and potential risk of moving higher. Let's talk about appreciation of real estate. Home values continue to set new all-time highs. The Case-Shiller Home Price Index, which is the gold standard for appreciation, showed that home prices rose 0.2% in July, rising to another record high. Prices are now 5% year over year, down from 5.5% in the previous report, due to higher price gains last year that are being replaced in the annual calculation. 10 and 20 city indices were higher than the nationwide figures, showing that the big cities are outperforming the rest of the nation. Additionally, lower priced homes appreciated at a faster rate than the overall market, which makes sense as there is greater demand. The 10 city index is up 6.8% year over year. 20 city is up 5.9%. Leading the way with price gains was New York City, Las Vegas, and Los Angeles. The lowest price gains were seen in Portland. Prices still higher. FHFA released their house price index, which measures home price appreciation on single-family homes with the conforming loan limits. Different than the Case-Shiller, it does not include cash buyers or jumbo loans. The FHFA reported that home prices rose 0.1% in July and are up 4.5% year over year, which is down from 5.3% in the previous report. Despite the negative media, home prices continue to move higher and provide a significant wealth creation opportunity. We may even see appreciation figures accelerate if rates continue to moderate and there's more demand to bid prices higher. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990.